seems like I'm a little out of sorts. This is only the second webinar, web seminar that I've done. So I'm still at the beginning of the learning curve. I imagine quite a few of you are old hats at this by now, old hands. But hopefully we'll be able to, address some of your questions and concerns as we go along regarding how can you save for the future while you're still working on paying off where you've been, paying off the past. Just a little bit about myself so you kind of have a background to work with. Again, my name's Ed Foster. I'm a local person. I graduated from Portland State University. I actually grew up in the area with a degree in English. I've been in this business I'm going to be starting my 19th year in January. And my father started it in 1981, Foster and Associates here in Oregon. He just retired this year. Spoke to him today down in Belize, the bum. Weather's nice down there. Anyway, I'm a registered representative and an investment advisor representative. That's probably Greek to most people. It was for me for the first couple of years. It means I can do a lot of investing. More importantly, I do work very closely with NEA member benefits and with PAT membership. And that's really been my focus for, almost the entire time I've been doing this, actually. And because of that, I like to tell people that I do, in fact, understand PERS. I know it's a big statement, but I think I have a pretty good handle on it. So that's kind of what I do. Primarily helping people focus on income goals, if you will, both pre and post retirement. And then lastly, been married 25 years. I do have 3 kids, so I feel your pain. 2 are in high school, 1's in college. 1 great dog, 1 cat that thinks it's a dog, and 1 pretty normal cat. But that's me. Today, I'm hoping that we'll be able to shed some light on kind of a brief overview of what your retirement plan looks like and why that's important. Why, even with those, you might want to save for retirement. How much you should save for retirement if you decide to do so. How you can save for retirement, even if you're paying off debts, and let's face it, all of us have debts. And tied together with that, we'll have to look at interest rates and issues, time horizons, and other industry slang, if you will. And then we'll talk about debt a little bit. There is such a thing as good debt and bad debt. And then we'll lastly look at some of the tools available to you to handle those debts, manage those debts, including the 403B or TSA tool. So without further ado, we'll dive right in. I call this the usual cast of characters for all members that I know of in the PAT, PPS school district. These are what I call the usual cast of characters. When we talk about retirement, these are the resources or entities from which we draw retirement funds from. So we'll look at each of those in turn. First, some good news, and let's face it, this year, good news is welcome. Even if you're not currently saving for your retirement, you are, in fact, saving for your retirement, just doing what you do. And that's because of the pension plans that are in place with a couple of these entities. And we'll talk about that a little bit. So good news, even if you're not actively saving for your retirement right now, you're not in limbo. You are, in fact, working towards funding your retirement. And one brief aside, this is kind of geeky, but I'm in the industry, so it's what I do. In putting this together, I chose the old Social Security logo. This was the logo that was originally on my Social Security card, and well, I won't say anymore as far as how old that is, but it's changed a little bit here recently. It was originally designed in 1936, and I didn't know this, but it was designed by a fellow by the name of Fred Happel from Albany, New York, and he earned $60 for designing the original Social Security card, and he was also the person that designed the Flying Tigers logo for General Charles Chennault in World War II. I just thought that was interesting. Okay, so we'll move on to specifics here a little bit. So we're going to start small and work up. Retirement plans, PPS. There isn't one. So that makes it pretty easy. Moving on. No, just kidding. Technically, you don't retire from PPS. You resign or you separate from service from PERS's point of view. But they don't, like most public employers, they themselves don't have a retirement plan. Now, that being said, while you're working for PPS, they are contributing to PERS, so they are paying for retirement a little bit, but it's not necessarily earmarked for one individual. That being said, there are some incentives and benefits that the district offers for retirement. Now, I'm not going to say too much about that at the moment for two reasons. One is the best case scenario, those are contractually negotiated items. And right now you can find them in Article 15 in the contract. Worst case scenario is it's a memorandum of understanding, but they are subject to change. And because of that, it isn't something we really use a lot for long-term retirement planning. That's not to say it isn't taken into account or consideration for people that are retiring soon. But for long-term planning, there just isn't a lot there. That being said, it's important to keep in mind that 403Bs, and we'll talk about that more later, 403Bs or TSAs are considered an employer-sponsored plan. So if you were to go on the web and want to look up rules and regulations for employer-sponsored plans, that's where you would find information about 403Bs. But I'll be wrapping this up with more about 403Bs, so that'll help clarify that. And again, those are funded through payroll, your contributions anyways, not the employers. So retirement plans in and of itself, that's not really the PPS's bailiwick. When we talk about retirement, really far and away from most educators, PERS is what we're talking about. It's the foundation of your retirement. Many people find it confusing, and that's understandable for a couple of reasons. One is it's not just PERS, of course, it's tier 1, tier 2, or what they should have called, in my opinion, tier 3, but is now OPSRP. So it's got some variations on a theme there. And this is primarily why PERS is confusing. It's actually two pension plans or two retirement plans. It's what is referred to as a hybrid plan. So when I say you're already saving for your retirement, this is where it's happening. The first part of the hybrid is a defined benefit. Now, this is becoming much less common in the country. It used to be kind of the standard, grandpa worked for GM for 30 years and retired with a gold watch and a lifetime income. That's becoming much less common, but you do still have that. This is called a defined benefit. It's a guaranteed income for life. And you get that just doing what you do. You don't need to set aside, you don't need to sign up for it. It's part of your benefits package as a public employee in the state of Oregon. We'll talk a little bit more about that in a minute. The other part of the hybrid part of it is the defined contribution. Now, this is much more common nationally now. Most people have heard of a 401k, for example. You have a 401a because you're a public employee. It's your IAP account, and a percent of each paycheck is invested on your behalf in an investment. So you're already saving literally cash for your retirement right now. Now, how much are you saving depends upon how much you're earning, of course. Should be okay here, hopefully. Double check something real quick. I just got a little message about I'm being unstable. Okay. If you're tier 1 or tier 2, 3.5% of your gross pay is going into the IAP account. If you're OPSRP, then it's 5.25%. So that's what's going on there in a general sense. It's a hybrid plan. You have both. Now, looking at a little more specific here, going back to that defined benefit lifetime income part of it, that's primarily based on how long you work and how much money you make while you're working. Really all there is to it. Not a lot you have control over, except whether or not you quit, I suppose. But it's based on years of service and highest average salary at retirement. Now, that's true for a vast majority of people now. If you were hired before 2000, certainly before 1996, if you're tier 1, then there's another way that pensions can be calculated. But the bottom line is, regardless of how PERS calculates the pension, you do in fact get a pension or an income for life. When you retire, you can also share that income with a named beneficiary, should something happen to you. So from a planning point of view, we can take spouses or partners into account. How much money can you expect from that? Well, in 2018, the average retiree received $2,812 monthly, and that's before taxes. That equates to, on average in 2018, as a 42%, what we call a replacement ratio of 42%. And I'll talk more about that in a minute, but replacement ratio is just another way of saying 42% of what a person was making before they retired. Okay. Just to tweak that a little bit and throw some more numbers at you, because I'm sure we haven't had enough of that today. The average for people that have 30 years of service or more is higher, of course. The average income was $3,628, or 51% replacement ratio. But the reason I kind of hesitate to even share that is the percentage of retirees in 2018 that retired that actually had 30 years of service is only 8.8%. So when you ask how many people actually make it to 30 years, the answer is, well, right now, not many. That may change. I'm sure that this number takes into account quite a few tier one people that could retire with full benefits before 30 years. But just so you have some idea of what you're looking at there. I know sometimes when you hear people talk about PERS, they make it sound like you're going to be rolling in the dough. For most people, that's not really true. It's an average retirement income. But that's something you're guaranteed. And we can go into specifics. You can email me if you have specific questions about your particular tier, but in a general sense, that's what we're looking at for the defined benefit, income for life. Doesn't matter how long you live. The other part, of course, is that defined contribution. In many ways, this is much easier. It's X number of dollars going each month. Yeah, again, if you're tier one or tier two, it's 3.5% of your gross pay. If you're OPSRP, it's 5.25%. It used to be 6%, but that changed in July of this year. Contributions are invested on your behalf in the market. You used to have no say whatsoever how it was invested. But that's changed. Now you do have a little bit of control over it. You can choose one of 10 target funds. The idea behind a target fund is, well, let me back up a little bit. There's supposed to be a relationship between risk and return. And as a person gets closer to retirement age, you want to take less risk, right? So you can change how you're invested to try to mitigate risk. So a target fund tries to mitigate risk based on how close a person is to their target. The target for the IAP account is age 65. So however close you are to age 65 helps determine what target fund you might want to choose from. Like I say, currently there are 10. You can change which fund you're in once a year. You can actually be in more than one fund. You can have 50% in a fund that's 10 years away from age 65 and one that's 15 years away if you're trying to balance risk, so that you can actually play around with it a little bit there. But those are your choices. And again, the target is age 65. When you retire, you get whatever the account value is at that time. It's cash. There's no guarantee, no lifetime income. They don't match it or anything. It's pretty basic. It's cash and carry. So no guarantees. Typically, people, when they retire, will roll that over to an IRA or some other tax qualified vehicle because the money hasn't been taxed yet. But that's specifics you don't need to worry about. What I would suggest, the takeaway from that is you're already contributing somewhere between 3.5% and 5.25% of your paycheck in a retirement account. And that's the IAP. It's a 401A. So that's PERS in a broad sense. The other part of the equation is Social Security. And I've met people that don't believe they're actually going to get it, but as things stand right now, you're on track to get it. It's also a defined benefit plan, just like the first part of the PERS thing we were looking at. So it's a lifetime income, and it's based primarily on when you retire and how long you've worked. The average lifetime earnings over 35 years. You can start benefits as early as age 62. Keeping in mind that if you do so, that reduces the amount you would get as compared to the full benefit. If you retire before you're eligible for your full benefit, there's an income cap. If you make more than that right now, it's $18,240. If you make more than that, then Social Security is going to want some of the money back. Full retirement age for Social Security is between age 66 and 67, depending upon your age or when you were born. If you were born after 1960, it's age 67. If you're born before that, then they kind of walk it back a little bit, month by month, and you can figure out what your full retirement age is. The average benefit for that is $1,514 per month. So no one's getting rich on Social Security either. But it is what it is. In terms of replacement ratio, we're looking at less than PERS, 24 to 30% of a person's pre-retirement income. Now, again, that's an average nationally. So your mileage will almost certainly vary, but it's good to at least have a ballpark idea of what is being offered. So I've mentioned replacement ratio now a couple of times. I want to talk about that just a little bit. What is a replacement ratio? Well, like I said, it's how much of your income you can expect in retirement as a percentage of what you were making before retirement. There are some guidelines for that. 70% is kind of the benchmark that we start with. It's the industry standard. The idea being that if a person can retire with 70% of their pre-retirement income, they can generally maintain their lifestyle and be comfortable in retirement. So 70% kind of becomes the initial target that we look at. Now, I want to hedge that a little bit. It's just a rule of thumb. Everyone's a little bit different. I've seen some good cases for it needing to be less than that, actually, because expenses do generally, statistically, go down when a person goes into retirement. And I've seen cases where more would be better. So is 70% the right number for you? I don't know. We'd have to talk about it and look at some of the specifics in your world. But it's a place to start. So 70% is sort of what we're looking for. If we're looking at why safer retirement, then that 70% comes into play. First off, PERS and Social Security don't equal 70%. They come in at 67. Now that doesn't take into account the IAP account. The reason for that is we don't know what it's going to be worth when you retire. You can do some compound interest calculations and kind of get a ballpark idea, but lacking specifics, I personally like to err on the side of caution. With but one exception for tax reasons. I really haven't met anybody that retired with too much money. So we take the IAP into account for income planning, but it's nice to build in a little bit of wiggle room too, just in case the market's doing something funny right about the time you want to retire, for example. Another consideration as far as why you might save for retirement, given that you have those other plans, is age at retirement. If you retire before your full Social Security age, for example, maybe you don't want to take Social Security until you qualify for full Social Security, age 67, let's say, but you want to retire at age 65. Well, some additional savings to bridge that gap from when you retire to when you turn on the Social Security might be a good idea. From experience, I do know that many people do in fact start PERS or retire from PERS before they start their Social Security. So there's usually a little bit of a window there. And then another consideration, of course, is both PERS and Social Security are fixed. And by that, I mean, they're great, make no mistake. You're going to get an income for life, but it's set. You know what it's going to be each month. And if something comes up and you need more of it, you can't call the Social Security office or you can't call the PERS office and say, hey, I need a new roof, a tree branch went through it, send me an extra $1,000. That's not what they do. So having some additional savings for when you're in retirement to help with those incidental expenses is desirable as well. And then lastly, control, flexibility, and having some options. With the exception of being able to choose target funds, you don't really have a lot of control right now over how your investments are being handled. And more people want to be a little bit more hands-on. They might want to decide, what sort of companies to invest in, how much risk to take, how much risk not to take for that matter. You see where I'm going with that. So having an account that you can use to offset whatever PERS or Social Security is doing is sometimes of benefit as well. So those, I think, are good reasons to save for retirement. Great. How much should you save? Well, keeping in mind that 70% is just a target number, we can start by looking at that. Let's say it's a good place to start. So we add up what you can expect to get in retirement, and we find that you're short by a fair amount, let's say, from the 70%. Well, that difference gives us an idea. We can calculate with that how much monthly you would need to save to have X number of dollars in retirement to close that gap so that you do, in fact, retire with 70% of your pre-retirement income. So that's one way to go about it. Granted, it's a kind of a convoluted way to go about, but it's what I do to figure out how much you need to save for retirement. Another way to go about, or at least to start, would be to replace what they are no longer contributing in the IAP account. Before July of this year, 6% of your paycheck was going into the IAP. Now it's less than that. So you could make that up by setting up a new account, a 403B, for example, and contributing the difference there. PERS actually will let you make up the difference into the IAP account out of payroll if you want to do that and have it go directly into the IAP account. But it's with after-tax dollars, which I thought was interesting. And once it's in the PERS system, then it's in the PERS system, and you don't have any more flexibility with it. So if you're going to be saving, you might as well do it in such a fashion that you have more control over it, in my opinion. Another one, and this is one that gets used quite a bit, is what can you afford? Sit down and figure out your monthly budget, and we'll get to the debt part of that in just a minute. And if there's a little bit left over that just seems to be disappearing at the end of the month, well, maybe that disappearing amount could go into a retirement savings account. If you do decide to set up a 403B or save for your retirement, and you have the option to do so, I would recommend figuring it out in terms of a percentage of pay, and entering that as the amount you would like to contribute, as opposed to a specific dollar amount. So, for example, when you sign up for a 403B in the important public schools, you can choose a percentage over a dollar amount. So you might do 2% of your pay instead of $100 of your pay. And that way, when you get a pay increase, the amount you're contributing also goes up. Because again, when you retire, we want to try to bring in a certain percentage of what you were making before you retired. And then time and compounding, we're going to talk about that more later, but the primary idea here is it's better to start, because of compounding, better to start saving for your retirement as soon as you can, as opposed to waiting and then trying to save a lot in the back end. And we'll talk more about that in a minute. So how much should you save? The short answer is any amount you can. Okay. Of course, one of the roadblocks that people have when they try to save for their retirement is debt. Debt is unavoidable. We all have it. I know quite a few teachers still have student loans that they are working on and feel like they're never going to be done with, frankly. But there are ways to manage that debt while still saving for your future, and that's what we want to look at here. One of the things you might try or consider is determine that savings goal. It can be frustrating when in your mind you're thinking, I need to save $200 a month for my retirement, but I've got the student loan payment, so I can't set some money aside for my retirement. Well, if we do an analysis and to come up with that 70%, let's say you only need to save $75 a month. Well, maybe that's a little bit easier to come up with than that $200. So figuring out what the savings goal is the first step in figuring out how much money goes to the debt and how much goes into savings. It might be lower than you think. And then we're going to be doing this going forward in the seminar here, but it's not a lot of fun, I understand, but it's a lot of times it's necessary to get down into the weeds and look at some of the things that are not as fun to look at or deal with, especially after a long day at work. Debt relief programs, prioritizing your budgets, doing a cost benefit analysis in terms of, okay, interest rate is here, earnings are over here, which one should the money go to, that sort of thing. And then long-term planning, and that's using time in the calculations, and I'll talk about that in just a minute. I call all of that down in the weeds a little bit. The truth of the matter is, I know a lot of people don't enjoy doing this, but if you want to get where you want to go, sometimes that's what you got to do. So I'd like to give you an example of that. I suppose I've been at it for about half an hour now. Maybe I'll pause and see if there's any questions before I get into the examples. Peter, are you there? Kelly? Anybody home? Hello.
I don't see any hands and nobody's
Okay.
putting any questions into the Q&A box, but just for all you guys out there in attendee land, feel free to, if you don't want to raise your hand right now, drop the question in the Q&A and we'll get back to you.
That'll work. That'll
I
work.
see one. Do you know how we tell which tier we're on in PeopleSoft?
Yeah. There's two ways, actually. One, I can tell you. And two, if you look at your PERS statement, it'll tell you on there as well. But short answer is, if you were hired before 1996, you're tier one. If you were hired between 1996 and August 28th, I want to say, of 2003, you're tier two. And if you were hired August 29th of 2003 or later, you are OPSRP.
So no need to go to PeopleSoft, just know your birth date and what Ed just said. Any other takers? All right, here we go. Here's another one. Is a Roth, IRA, or a 403 better?
That's actually an interesting question. I'm gonna answer that specifically a little bit a little later in the seminar.
Right.
Just a short answer to that, just to not leave you hanging out there though, is both 403Bs and IRAs come in two different flavors. It's kind of like Snickers and Milky Way. Essentially the same candy bar, but one's got nuts, the other doesn't. Roth is after-tax contributions to the investment. Could be an IRA, could be a 403B. And not Roth is called traditional, and that can also be an IRA or a 403B. Which one is better? Well, again, I'll talk about that towards the end. It kind of depends on what you're trying to achieve. So maybe we can circle back to that. And you can have both, by the way. So.
Thanks, Ed.
Sure. Okay. Well, yeah, just in an effort to get there, we'll push on then. Okay. So here's an example. When I say, figuring out what you need to save, or getting down into the weeds a little bit and doing a cost benefit analysis. Here's just an average example. Let's say a person has a $10,000 debt. Could be a student loan, could be credit card, I don't know, it doesn't matter. And it has a 10% interest rate. So right now they're paying $200 a month on it. At that rate, with those payments, it'll be paid off in 65 months. Total interest paid in that 65-month period of time will be $2,990. So they took the $200 a month, sent it in, and are done with it. Didn't set any money aside for retirement. So after 65 months, the debt's paid off. You paid almost $3,000 in interest, fine, but there's nothing saved for retirement. Well, what if we were to peel off $25? And so same debt, $10,000, same interest rate, 10%, but instead of sending $200 a month to the debt, we sent $175. Now that's going to stretch out how long it takes to pay off the debt, of course. So we go from 65 months to 78. And because the debt's there longer, there's more interest, $3,636 as opposed to the $2,990. But after 65 months, after 65 months, we now have a retirement account of $1,691. But of course, you paid more in interest, right? So does it really work out? Well, on the 65-month plan with no retirement account, you paid $2,990. On the 78-month plan, you paid more in interest, $3,636, so an additional $646 in interest. But we were able to save $1,691 for retirement. If we subtract the interest from the savings, the debt's paid off, and we have a retirement account with over $1,000 in it. So that's one example of doing what I would call a cost benefit analysis. The key to that, of course, is having the time to do it. We need to have the 65 months, we need to have the 78 months for that compounding of the amount being saved to equal more than the interest. And so that brings us into the concept of time. That wouldn't work for someone that had only 1 year to save, for example. So what we're talking about is time horizon. Time horizon is the period of time one can expect to hold an investment until they need the money back or the benefit from that investment. It ties in with that risk and return I talked about, the idea being that with shorter time horizon, you want to take less risk. Conversely, if you have a longer time horizon, you might want to take more. As a general rule of thumb, I think that's true. I tend to be a moderate person myself when it comes to things like that. I don't believe in swinging for the fences if base hits are going to get you where you want to go. But that being said, in terms of general principles, the idea is valid. The other part of that equation was compounding. The $25 a month we were putting into the retirement account, for example, in that previous illustration, was assumed to earn 6%. So compounding is the process when an asset's earnings from either capital or interest are reinvested to generate additional earnings over time. Another example of that would be, let's say you set aside $100 a month for 10 years and you each month took $100 and put it under your mattress. After 10 years, you'd have a very comfortable mattress, I imagine, and $12,000. If you took that same amount, $100, and put it into an investment that earns 6% for 10 years, over that 10-year period of time, you would have $16,247 or a 26% return. So again, it's the idea of tying the two together, both time and earning something with that investment over time. I'm going to show another example here in a minute. I don't want to wear everybody down with too many examples, but kind of pulling back just a little bit. Going on with the debt, there are different types of debt, of course. There's good debt and bad debt is generally how it's referred to. Good debt is a loan that has the potential to increase your net worth over time. And student loans fall into that category, actually. The old adage, it takes money to make money. So examples of good debt would be a student loan or paying for an education because of the higher income potential. Business ownership, COVID impact on small businesses aside, again, potential for higher income. And real estate and home ownership. Mortgages aren't fun, but you are increasing your net worth every time you make a mortgage payment. So that's considered good debt. Bad debt is usually more fun, but it involves borrowing money to purchase depreciating assets. In other words, something that isn't going to be worth more later on. It generally won't go up in value or generate income. If it won't go up in value and generate income, you shouldn't use credit to buy it. Shouldn't debt to buy it. So examples include cars, especially new cars, because of depreciation they take coming right off the lot. Now, there's something to be said with quality of life as well. This does not take that into account. This is just looking at whether or not something increases net worth. There's a point in time in everyone's life where they really would like that new car smell and good warranty and just want, and that's understandable. So this doesn't take that into account. But in just from a financial planning point of view, I had to put it in the good debt or bad debt column. It would have to go in the bad debt column. Same thing with clothes, consumables, goods and services, that sort of thing. And then lastly, big surprise, credit cards. You're borrowing money, and oftentimes these are used for purchases that don't increase net worth. Okay, so be cognizant of those terms. Part of what helps determine whether or not something's going to be good or go up in value is our interest rates and rates of return. Don't worry, I'm going to tie all this together in a minute here. So interest rates are the amount a lender charges for the use of assets expressed as a percentage of principal. So every time you use the credit card, what you're doing, of course, is borrowing money from the lender, and as a cost for that is a percentage of whatever it is you're borrowing, the principal. Same thing with home loans. Rate of return is sort of the opposite of that. It's the net gain or loss of an investment over a specified period of time expressed as a percentage of an initial investment's cost. So I'm trying to think of an example. Obviously, an investment in the market, you invest $100, it earns 6% for 10 years. The example that we showed earlier, that sort of thing. That's a rate of return. What we're trying to do at some point is balance, where's better? Are you making more than you're paying in interest or not? And that comes into play in terms of figuring out is something worth doing. This will maybe make more sense if I show you an example. And I actually see this from time to time. The idea that grandma wants to gift the grandkids or give you X number of dollars as a gift. Right now, the gift amount is $15,000 for 2021. It's going to be $15,000. A person can gift another person without there being any sort of tax consequences. So, an example: let's say a person has a home loan of $100,000 at 3.5%. They got about 10 years left remaining on their mortgage. So, doing payments for 10 years at that amount, you're looking at paying $118,663. So over 10 years, that person's paid $18,663 in interest. If we were to take the $15,000 gift that grandma wants to give us and put it towards the principal, lower that from 100,000 to 85,000 and keep the time the same, what are we looking at? Well, that lowers the amount that's going to be paid over time, of course. The interest paid went from 18,663. Now it's on 85,000 instead of 100, so it's 15,864 in interest instead of that 18 number. So we've saved $2,799 in interest by applying grandma's gift of $15,000 to the mortgage, which sounds great. But what I get asked is, should I do that, or would I be better to invest it? Well, let's take a look at that. So we take the same $15,000 and invest it for 10 years with an average annual rate of return of 6%, which is moderate. It's actually a little bit below the market average, but given how weird things are, I'm comfortable with that. After 10 years at 6%, the $15,000 is now $26,862. Now we did that, we invested it instead of putting it towards the mortgage. So we have to add that interest back in because we didn't save any money on the interest. We kept the full $100,000 loan. So we subtract from what we made on the investment, $2,799, that interest. So we still come out ahead, $24,063. So in this scenario, it's better to take grandma's gift of $15,000 and invest it than it is to put it towards a mortgage. That's what I meant a couple slides ago by a cost benefit analysis. Now, obviously, this is just an example. Your interest rates might be different. The amount of money we're talking about might be different. The amount of time we have to stay invested might be different. Getting that 6%, that involves a little bit of risk, and some people aren't comfortable with that, and they're more comfortable with an investment that's going to earn 4. Well, numbers might not work out as well that way. So the specifics are going to vary, but the general principle is true. Doing this sort of thing will help you determine whether you should put money towards debt or invest it. And it could be a home loan, it could be a student loan, which brings us to the next slide, actually. So student loan debt. First disclaimer, I'm not an expert on it. Why? Because it's really confusing, but I know people who are good at it. Like I like to tell people, it's not important that I know all the answers. It's important I know where to find the answers. One of the places to find the answers is with the NEA, NEA member benefits. They have some great programs to help people navigate the student loan environment. Easy to find, neamb.com. A couple of clicks and then you see you can see it, the student loan forgiveness and refinancing part of their webpage. They have a do-it-yourself kind of thing. They've got some specialists that can help you with it. So there are some options there. And I would strongly recommend checking that out. The other thing to look at, and again, this is down in the weeds a little bit, but I know people have shied away from it because it's a daunting prospect and certainly can be confusing. But we're talking about your money, so it's worth knowing the ins and outs of the Public Service Loan Forgiveness Program, which is applicable to direct loans. It's worth learning about the Teacher Loan Forgiveness Program, which is applicable to direct loans and FFEL programs. or even the Perkins loan cancellation discharge. I know these are fairly common. In fact, Teresa Munch of NEA Member Benefits usually does a seminar at PAT at least once a year, sometimes twice, on the specifics of these individual programs. And I can all but guarantee we will do that again in the coming year. But that in and of itself, just those three topics can take 2 hours. So I'm not going to go too into detail that yet. But again, between the NEA's website and feel free to email me with questions. We can find you some answers on that. But one thing I wanted to share with you, particularly regarding the loan payment. I know that one of the plans, one of the more popular ones actually, is the income-driven repayment plan. I see this one quite a bit, the IDR. Basically, it's the payment that a person makes each month is a percentage based on their adjusted gross income. Very common. Why would a person want to do that? Well, it can lower your payments in most cases. The plans can be quite long, going as long as 20 to 25 years. And then if you haven't paid the whole thing off yet, at the end of that period of time, the rest of the loan may be forgiven. So if you can get on an IDR, I think it's a pretty good idea. From my point of view, from a financial planning point of view, it's the key here is the adjusted gross income, because it is determined after contributions to retirement savings plans. So, for example, contributing to a traditional, I'll get to that in a minute, but contributing to a traditional 403B or TSA lowers your taxable income. So not only are you saving for retirement and paying less in taxes now, you're also lowering your monthly payment on the IDR plan as well. So with that, I think it's important to have at least a passing familiarity of what a 403B is and how it can help you do this. In a broad sense, 403B is just a tax-deferred retirement account. 403B, the terms are kind of interchangeable. 403B and TSA, you hear either. I use either. 403B is a section of the U.S. tax code, section 4, paragraph B, blah, blah, blah. In fact, the IAP is a 401A, same code. So if you go to section 401, paragraph A, you'll see stuff about the IAP. If you go to 408, you'll learn about IRAs. So it's all a function of the tax code. TSA is just tax sheltered account. They are funded through payroll deduction. So the money is invested with an investment company, usually in mutual funds or sometimes in variable annuity sub-accounts. Once invested, typically the money stays there until you start retirement and begin withdrawals. So in a nutshell, that's what a 403B is. Compared to an IRA, there was a question about Roth and traditional. This is where we start to get into that a little bit. Just like an IRA, an individual retirement account, a 403B can either be a Roth or it can be a traditional. Now, what that is the 403B is the investment choice vehicle, let's say. And then you overlay that with whether or not it's going to be Roth or a traditional, like a clear coat on a car, I guess. If you spray on the Roth, then what you're saying is, okay, I'm going to fund it with money that has already been taxed, after tax dollars. The advantage to that is when you go to take the money back out, presumably in retirement, not only is the money you put in, but the money it earned taken out without taxes, tax-free. That's the advantage to a Roth. Okay. Disadvantage for purposes of our conversation is because it's after tax dollars, it doesn't lower your income for purposes of determining the IDR. Okay. So is it better or worse than a traditional? Well, traditional is kind of just the opposite of that. So it's funded with money that hasn't been taxed yet. It grows tax deferred. And then when money comes out, whatever is taken out is just added to your income for the year and taxed accordingly. Because it's taken out before taxes are calculated, it lowers your gross income, both for the amount in determining the taxes you're going to pay for the year and for determining the IDR. So which one is better? Well, it kind of depends on what you're trying to do. If you're trying to save money on taxes now or lower your IDR, then a traditional makes more sense. If those aren't pertinent to you, relevant to you, then a Roth might make more sense. So it kind of depends on what you're trying to do. In my opinion, if you're not trying to save money on taxes and you're not on an income-driven repayment plan, and you have more than 7 years to retirement, then I think a Roth is preferable to a traditional from a tax point of view. If that's not the case, if any one of those things is not the case, then a traditional might make more sense. And if you want to email me with kind of where you're at with it and need some clarification, I'm happy to give you my 2 cents specifically to your situation as well. Now, where a 403B is different than an IRA, and in my opinion, better, 403Bs are a retirement savings account just like an IRA, but they're only available to nonprofit organizations, primarily educators, not the general public. That's probably one of the biggest differences with an IRA. Another difference is they're funded through payroll deduction. So you sign up for it, and we'll talk about that in a minute, through the payroll office. And it's deducted from your paycheck. So you don't write a check at the end of each year, for example, and then deduct it from your taxes. It's done as you go through the pay process. Contribution limits are quite a bit higher for 403Bs than they are for IRAs. For next year, for example, and I believe PPS just sent out a memo on this, contribution limit is $19,500 for a 403B versus $6,000 for an IRA. And there's even a catch-up provision for people that are over age 50. For a 403B, it's $6,500. For an IRA, it's $1,000. So a lot more wiggle room there as far as contribution limits are concerned. And the 2 other big differences, and this I see these come into play quite often actually, is IRAs are generally only accessible after age 59 and a half. Taking money out of an IRA before then could result in 10% penalties from the IRS. For a 403B or a TSA, that's not necessarily true. Depending upon how the plan document is written, and most are written to do this, you can start taking distributions from your TSA as early as age 55 with a separation from service. Okay. So more flexibility there. And then lastly, the 403Bs, almost all that I can think of, have a loan provision so that you can borrow money from yourself, essentially, from your 403B account. There's some stipulations on how that works and how long it takes to pay it back, but generally speaking, you can take 50% of the account value or $50,000, whichever is lesser. You can't do that with an IRA. And I've seen this done a couple of times to come up with a down payment for a house. Maybe you're buying your own car and you just want to borrow it from yourself, that kind of thing. So there's more flexibility there. So all things being equal, I do prefer the 403B. Okay, so great. I've got you sold on getting a 403B. Now, how do you get one? Well, again, I said it through PPS. And again, that's why I have the PPS logo here. They themselves don't necessarily have a retirement plan, but they are part of what it takes to get a 403B set up. First thing you do, of course, is select an investment company. Now, because it's payroll funded or done through your payroll, there has to be a payroll slot. So, and in Portland, there are 12 payroll slots for this sort of thing, 12 companies to choose from. So the first thing you need to do is figure out which company you're going to invest with. Then figure out how much you're going to invest. Then comes that maybe a little bit trickier, figuring out whether it's going to be a traditional or a Roth. Good news is you can do both. The contribution limits are the same. So it's the 19,500 max is applicable, whether it's all in traditional or split between traditional and Roth and so on. But you could have either. And Portland's payroll office is set up to accommodate that. So you open an account with that investment company. Then you just go through the PeopleSoft or the PPS benefits portal and sign up there. And I actually have a PDF from PPS that I could shoot over to you if you need it that explains how to do it. It's under life events. You just sign in to tell them how much you want to contribute and where, and that's it. That's all it takes to set up a 403B. Some companies you can do it online. Other companies maybe involve a little more paperwork and meeting with someone in person. If it seems like a daunting prospect, then there is another way, and that would be to meet with me. How to get one, talk to me. So this is where I toot my own horn a little bit, but a couple of things. First, the reason I say that is I am familiar with teachers' needs and goals. I know how important certain things can be, whether it be environmentally conscious investing or needing to save X number of dollars to get where you want to go. I know how it works. And to be fair, I will be honest. I won't try to sell you something if you don't need it. If you're a Vanguard sort of person, that's fine. I'll tell you everything you need to know, and then you can take it up with Vanguard. I'm not going to try to sell you anything you don't need. That being said, being licensed as I am, I do offer a wide range of financial products and services. So if you have a need and I have a product that'll meet that need, of course, I'm going to bring it to your attention. One of those, and I'd be remiss in my duties not to mention, this is in fact the NEA member benefits sponsored program of the retirement program. It's underwritten by a company called Security Benefit. I'm the provider of that in the Portland Public School District. They have some wonderful financial products, including some socially responsible investments to choose from. I'm happy to sit down and share that with you. The amounts I see invested typically, they're all over the map, but on average, I'd say the average person I work with invests $100 to maybe $250 a month. So not a lot. Minimums usually in the 25 to 50 range. And depending upon what we do or anybody else you work with for that matter, they're going to get paid in one of two ways, either by commission or by fee, and I can do either. So that's another way to get going with the 403B is the paperwork can be a little confusing sometimes, and I'm happy to help you with that. But I'm not going to do somebody else's job, just so you know. That being said, I have once or twice helped people just set up a 403B and not got down into the specifics with them because they didn't want to. But generally, people want to know more about their financial future and picture than just that, and I'm happy to do that. And that helps me with a recommendation. I don't sell product, so I'm not going to say, well, here's what you need without knowing what you need. So, take everything I've said here as general principles, not as this is an endorsement for one thing over the other. That would mean a lot to me.
I have a bunch of questions that I don't know if you want to wait till that.
We're right down towards the end of it. I was just going to summarize, so go ahead. What do you got?
So we'll take these questions, then go back to the summary and take some more questions. So one person asked, how do you find out more information about these 12 companies in order to kind of get the 403B?
Yeah. There are, well, I think did I print out that memo? Here we go. Well, here's the easy answer. So I know it's on PPS's website under their benefits, and then there's a retirement tab, and then they have a link to the individual companies involved. One of my, Rayanne actually just sent me a memo that came out from PPS, I think today, that talks about, here we go, 2021 403B TSA plan announcement. Yeah, it's dated today. To everyone in PPS. And on that email, roughly halfway down, there's a section that says Portland Public Schools 403B vendors. And it lists all the vendors and has all their website links or people to contact. So that would probably be the easiest way to start. Does that answer the question, hopefully?
Yeah, definitely. And somebody asked if there was a special PAT member rate for your services.
Oh, that's a good question, actually. Yes. For meeting with members, I am willing to meet with anyone free of charge at least once, often twice, and then we can take it from there. So I don't charge to do at least one consultation, put it that way.
Cool. Thank you, Ed.
Sure.
Somebody wrote in, Roth is not good if you're going to retire in 5 to 7 years. Question.
Right.
Yeah.
Yeah, and the reason for that, just kind of adding to that a little bit, because a Roth is funded with after-tax dollars, meaning you've already paid the taxes on Well, it needs time to grow to earn back what you just paid in taxes. Otherwise, there was really no point in investing it in Roth to begin with. So, depending upon the rate of return, of course, it takes time for that investment to earn back what you paid in taxes on it. And it's, from my calculations, it's running in the 5-7 year range, right in that, depending upon returns. Um, so that's very true. If you're going to retire next year and wanted to set up a 403b and we're going to turn around and take the money back out next year, I wouldn't recommend a Roth. Doesn't make any sense.
Great. And then we had another really good question. Somebody wrote, would I want to choose any of these plans if I'm not sure if they mean 403b or like all the ones we talked about. Would I want to choose any of these plans if I might want to pull from it for other investments or for children's education in the future?
Interesting. I would suggest that the plans that we've been talking about here, especially the 403b and the IRA, really need to be earmarked for retirement. Yes, you could borrow money out of the 403b to help fund a college education, deal with other incidentals that might come up. But that wouldn't be my recommendation. Any monies that go into the plans that we're talking about here really need to be earmarked for yourself and later on in life, would be my answer to that.
That's
I keep
great.
looking over here because that's where I've got your picture.
Somebody else asked, if you have some extra money after contributing to your 403b, do you recommend paying off more debt, e.g. above your income-based repayment plan for student loans, I guess, or whatever, or put that money into a savings account?
Yeah, that's an interesting question, actually. And that speaks directly to what we were talking about earlier with interest rates and rates of return. If you have a little money left over, what we're talking about is leveraging, frankly. If your loan is, the interest rate on your loan is, let's say 5%, but you've got an investment that will pay 5 or 10, then it makes sense to do the investment. Conversely, if the interest rate is killing you, it might make more sense to pay down the debt as fast as possible. So it really depends on what the rates of return are. From experience, if I had to choose between the two, it wouldn't be a savings account, for one thing. They're not paying enough to justify it. It would have to be something that has higher earning potential than a savings account. Otherwise, pay off the loan. Everything I've said is true, but I do know that when it finally comes time to retire, it's nice to retire with as little debt as possible. So that is a consideration. If you would be more comfortable with less debt, pay the debt.
And then from my friend Audrey asks, my partner already has a 401k, so is it better to add more to our contribution to that fund or for her to open up a separate IRA or 403b?
That's a good question. First thing that comes to mind is, does the 401k have matching funds? Does the employer match, and are you maximizing that? If the answer is no, I'm not maximizing what I could be getting from the employer, put it in the 401k first. Free money is good money. If you're maximizing the employer contribution to the 401k, then it becomes a question of, how do you feel about having all the eggs in one basket? How do you like the returns on the 401k? Do you like where it's invested? If you're happy every time you open up a statement going, yeah, then yeah, I think 401k is probably not a bad idea. 401ks, many of them also have a loan provision, so that's not necessarily a big differentiator with the 403b. It really comes down to how you feel about the 401k. Now, again, if you're not matching the employer, if they're not maximizing the employer contribution, definitely do that first.
Thanks, Ed. Somebody said they tried doing the student loan forgiveness program and they were told that they were in the wrong repayment plan. I don't know if that's too nitty gritty for you, or I'm not sure the details?
Yeah, I would want to get the specifics on that, and I may have to route it through Teresa or someone at the NEA for that one. I know I have a general idea of what they're talking about. There's the nuances of some of those plans are incredible. I would need to see the specifics on that one. Yeah.
Couple more, and then we can get back to the summary. Somebody said if they're looking at their paycheck, do I divide the OPSRP contribution by the gross pay to see their contribution? When they did that, it came out to 6%.
Yeah, that's right. But let's see, they changed it in July, August. So any paycheck stub you've been getting since, I want to say August, should be less than 6% now. Not necessarily the gross pay. No, it would be the gross pay. I was thinking it might be contract amount. No, it's gross pay. Yeah, and if you're OPSRP, it should be 5.25% now.
Yeah, two more here. Can you put more money into a 403B at the end of the year?
The short answer is no. Longer answer is sort of. Unlike an IRA where you can just write it a check, 403Bs are funded through payroll deduction or from rolling over another account. So there's no way to go, gosh, it turns out I did have a pretty good year. I didn't spend as much as I thought I needed to. I'm going to put the rest of it in my 403B. There's no way to write a separate check to that. If you think that's going to happen, one option would be to up the amount that you're contributing to the 403B for that month. It's a function of that software I was talking about, the benefits portal, and you can change it month to month if you want to. So if you can know a month ahead of time, you could up the amount you're contributing for a month or two.
Right. And then one question, Dave Ramsey recommends investing 15% of your gross household income into retirement. This has always confused me with PERS involved. Should we be doing the 15% or something else since we also pay into PERS?
He recommends 15%?
Right.
I don't like that. Here's why. That number in and of itself is irrelevant. What's more important is understanding what the goal is and then figuring out what it takes to reach it. 15% might not be enough. 15% might be far and away more than you need. So I would need to see what your goals are first and how much is currently being saved, both in PERS and any other investment you have, before I could say, yeah, 15% is a good number. I do know that on average, it takes a little bit less. I mean, you hear Dave Ramsey and you hear, Susie Orman and these other people. They don't understand. Let me put it. They're talking to the general public, not necessarily people that have pensions and lifetime incomes. So their recommendations have to be taken with the understanding that they're not talking necessarily to you. They're talking to people who don't otherwise have retirement savings. So that's the short answer to that.
Gotcha. That's it for our Q&A. So we'll get some more after you finish that. Thank you.
Well, hopefully we've addressed some of the issues here, the kind of an overview of retirement plans and why you want to save for your retirement, an idea of how much to do it, or at least how to approach the question. Yeah, I want to introduce the concept of interest rates, time horizons, and other in the weed stuff, so that if you and I do end up talking together, you can kind of understand what language I'm speaking. And then some different programs that are available that are worth looking at if you haven't done so already. If you haven't, it hasn't worked out, I understand. That being said, maybe we could do a cost benefit analysis and figure out a way to save for your retirement anyways. And that's again where the 403B might come into help. If you have questions, I'm happy to try to answer them. I work with a good gentleman that also is very conversant in these things. Feel free to email me. That's probably the preferred method, but if you want to call, that's fine too. Or you can call PAT and they'll route you my way. Obviously, we can do Zoom. I'm not opposed to face-to-face. Email's good too. It seems like there's another way. Oh, phone. Basically, I'm pretty flexible. Disclaimer saying this is all my best guess, and then that's that. So Man, we came in pretty early on that one. This is the first time I've done this particular seminar, so this is good. Anybody that wants to follow up with additional questions or give me some feedback, I would take it to heart. And again, I very much appreciate you taking the time out of what I'm sure is a long day um, to join me here and go through some of this. Hopefully it's helped a little bit, and I wish everyone a happy winter break. And thank you very much for your help, Peter.
Absolutely. Thank you, Ed. And thank you, everybody, for participating. And have a great night.
Thank you.
Take care.
Be well.
Bye.